Good morning or good afternoon, everybody who's on here. Very excited. We have Aakash Doshi with State Street, great partner of ours. Um, and we're going to talk about gold today. But he's going to do all the talking. I'm going to do a lot of listening and taking notes. But what I will say is, as we look at wealth management, we talk about this every month. There's so many different components to what really helps us to be successful as investors. And understanding, we watch TV, we hear about gold, we hear about all these different things, crypto and all these things. But now you have a chance to really hear from a true expert. And so I'm truly excited. In fact, I'm gonna quit talking and give it to you, Akash, so you can take it from there and start the presentation. And then at the end, just leave your questions for everybody in the chat box and we will have time for questions and answers um, um, at toward the end of this hour. All right, floor is yours.
Thanks, Glenn, and thanks everyone for joining today's webinar. I hope to have an interactive and fun discussion to explain the gold and gold commodity market in particular. By way of introduction, as Glenn mentioned, my name is Aakash Doshi. I'm with State Street Investment Management, and I'm the global head of gold commodities fund strategy here. And I hope to provide you guys with some tidbits and some knowledge of how I view the gold market, why gold works in a portfolio, and some implementation methods or some products that we have at State Street Investment Management, which are really the market leading ETFs in the space, and why that could be of interest to you. And of course, if that is, you should absolutely reach out to Glenn, and we're happy to have some follow up conversations as well. So I'm going to share my screen and go over a presentation, but I promise I'll try to make it a little bit more fun. There's not a lot of text. I'm not going to read a lot of text, but I think there'll be some interesting charts and an interesting framework for everyone to get a handle on gold. So first and foremost, just for technical purposes, since we're all in different locations, Glenn, thumbs up. Are you able to see the presentation? All right, perfect. All right, so my presentation today, gold still in a bull cycle and still an underowned asset. I'm going to break apart this conversation into three pieces. One, just a background in gold. What is gold as an asset? Why does it fit into a portfolio? That's going to be the first part because I know there are some of you that are going to be here that are experts in gold that might already invest and hold gold, both physical and financial. And there are going to be some people who are like, why gold or what is gold? The second part is what's the view, right? Now you've told me about this asset. What does that mean? Where is it going? And what are those structural drivers for it? And then lastly, I'll talk a little bit about implementation, including State Street Investment Management's leading ETFs, GLD and GLDM. So if that sounds good, Glenn, let's get started. And of course, if you have questions or we need clarification in between, please do feel free to chime in. I want to make this interactive. I want to make this fun. This is not going to be a professorial presentation, although I do think my professors at Columbia University will be proud of it. All right. So with that, let's go into the background. So first, I wanted to take a step back at a very 100-foot level and explain to everyone what is gold and really what are gold's unique demand drivers and what makes it an evergreen strategic core part of a portfolio in the modern era. And when I say the modern era, I mean over the last 50 years, kind of in the free floating US dollar era. Why does gold matter? Well, one is people often think of gold and they think of it either as jewelry or they think of gold as, oh, that's just a financial product. I'm invested in gold futures. It's a gold derivative. But really, what makes gold unique is that it really has unique sources of demand, variable sources of demand. And these diverse sources of demand make it a very unique financial and physical asset, a unique commodity and hard asset. So the way I break this down is I look at gold as having cyclical sources of demand, counter cyclical sources of demand, and non cyclical sources of demand. And this matters not just as a descriptive term, but it helps lower the volatility of gold and allows it to run through a complete economic cycle in varying stages. On the supply side, gold is also a very scarce resource as far as new mine supply. So it's limited and finite, and over time, its supply will get more and more scarce because it is a finite resource. But I don't have time to go into all of those details for our webinar today. Otherwise, Glenn will get pretty upset if I go into 30 minutes on gold mine supply. So let me start on the demand side here. What's cyclical? Jewelry, industrial demand. That represents combined anywhere from 40 to 55% of global gold demand. And those are cyclical. So gold is used in NVIDIA chips. It's used in Intel chips. It's used in AMD chips. There are a lot of technological applications for gold. So it's very much tied actually to growth in semiconductor usage. People don't know that, but I wanted to educate the audience in that. And then of course, jewelry. I'm wearing a gold ring and a gold watch right now. I can already look at Glenn and tell you that he definitely owns some gold jewelry as well. So from that standpoint, that is a part of gold traditionally, particularly in the East, in China and India, where gold is very cultural and significantly driven by family giving of jewelry and physical gold, but also in the West, where it's a big part of fashion and a big part of consumer and retail demand. But then gold also has investment demand. And that investment demand is about 25 to 35% of gold consumption. And that tends to be counter-cyclical. So you have pro-cyclical jewelry and industrial demand, which goes with higher economic growth. But then you have investment demand, which for gold can be viewed kind of as a left tail hedge or as a risk off hedge, and that's counter-cyclical, and that's 25 to 35% of demand. And then, of course, central banks. Central banks around the world, particularly in emerging markets, buy gold as a left tail reserve asset as part of its foreign reserves, as part of its de-dollarization and reserve diversification impulse. So you put all of that together, right? The reason I really wanted to display this is that gold is not just a financial asset. It's not just a derivative. It's a hard commodity asset. And because of these diverse sources of cyclical, counter-cyclical, and non-cyclical demand, if there's one thing you get out of this conversation, is that it allows gold to be a strategic core asset through an economic cycle, but providing three main benefits because of this unique demand. One is wealth preservation and diversification. Two, capital appreciation. And three, risk management. So let's dig into that. What do we mean by risk management? Well, many of you might have 60-40 portfolios, 60% equity, 40% bonds, or 70% equities and 30% bonds, called a 70-30 portfolio. Well, gold doesn't fit in. It's not an equity. It's not a bond. It's a liquid alternative. And because of this counter-cyclical investment demand, over history, gold has tended to perform well during volatility or equity market shocks and drawdowns. Here, over the last 40 years, we are looking at sharp S&P 500 US equity market corrections greater than 15%. So these drawdowns, you can see, have been numerous. They happened about every couple of years over the last 40 years. And what you can see is that gold tends to outperform. It provides a buffer in your portfolio when equities are drawing down. Now, that's not always the case. For example, in the late 90s, during the long-term capital management and Asian currency crisis, gold fell as well. But what you could see is that gold fell less than the S&P 500. I'm not saying that past data represents future returns, but I think this is a good historical example, including the trade war last year, including the global financial crisis, looking at various periods of market stress. You can really see gold holds its own. And that is good for a portfolio because gold is providing you risk management. It's providing you a buffer, a natural hedge in your portfolio. The second is capital appreciation. A lot of people ask me, Glenn, hey, Akash, gold does not provide a coupon. I want dividends. I want a coupon. That is true. Gold does not provide a coupon. No hard asset does. Oil does not provide a coupon. Copper does not provide a coupon. I won't get into complex structure where you can use derivative and options to get income. That's a separate conversation. But generally speaking, yes, if you own oil, you own copper, you own gold, any hard asset, it does not provide a coupon. That said, what gold does is it provides capital appreciation. So here's annualized total returns across time horizons as of the end of 1Q of this year. And I'm looking at a 10-year look back, 20-year look back, and 30-year look back. But let's take it back even further, right? Let's go back to 1971 and the Nixon shock, the US exiting the Bretton Woods system that existed post World War II, the US and Europe going to a free floating currency era. Glenn, if I asked you what have been average annual returns for gold over the last 55 years, what would you say? What would be your best guess?
5%.
Great guess. 5%. Actually, that answer is 8%. Average
Wow.
annual gold returns over the last 55 years have been 8%. Does that mean it's 8% every year? No, there's some years where it was 25%. There are other years where it was down 5%. But over the long run, gold is on a natural rise. If I asked for what real returns have been over the last 55 years, so that's inflation adjusted returns, real returns for gold have been around 3.5 to 4%. So that means gold is doing a key thing in your portfolio. On average, it's beating cash plus inflation as a low volatility hedge that provides risk off or equity volatility shock benefits and diversification benefits. And now let's dig into diversification because I think that's really critical. But before I do that, I also want to say it does it as low volatility asset as well. And volatility is often important because a lot of times, investors, clients, they'll look at a return for an asset and they'll be like, wow, this is incredible. Bitcoin prices have risen so much. What a great story. But they ignore the volatility. They ignore the ups and downs. So in this simple example, I'm looking at volatility, the actual realized volatility of gold competitors, quote unquote. There's really no competitor. Gold stands on its own, but let's just call it.
You know what?
Yeah.
I'm gonna stop you, Keisha. I gotta ask you a question on this.
Sure.
So typically, well, many times I've seen people who invest in gold also may invest in real estate, tangible things.
Sure.
Um, what's take away the tax benefits of um, real estate, or maybe you can even use tax adjusted returns. Have you done a comparison to look at, especially with you saying what you just said about gold in particular being one of one, gold versus real estate?
I don't look at gold versus real estate for one key reason, Glenn.
Okay.
I consider the competitors more the liquid alternatives, and real
Ah,
estate, as we know, is an illiquid
illiquid, right?
investment, particularly if you're looking for those tax benefits, right, through a partnership or LLC form as well, taking aside REITs, which also have their own tax issues or tax needs that you have to assess, right? For example, often more efficient to hold those in retirement accounts as they are versus after tax account, given how income passes through REITs. But not going too far off topic, the reason for that, Glenn, is I want to look at what's liquid, what's on the screen that goes in and out. So typically when people think about alternative fiat, they think about gold. That's the granddaddy of them all. But then they think about silver and they think about Bitcoin. What I just wanted to show here is just how less volatile gold is versus Bitcoin and silver. and actually how much more silver has become volatile in the last couple of years, even more so than Bitcoin year to date. So I just want to keep that in mind that Bitcoin is still a 50 plus vol asset, silver is a 25 plus vol asset, while gold is a 14 vol asset over the last decade. And it generally it realizes even lower volatility even than the S&P 500 if you look at kind of a long-term chart. But let's talk about diversification because I think that's critical, Glenn, for you and for your clients. So this is a busy table. Don't have to read it in detail, but basically what I'm showing here is a multi-asset portfolio. So this might not be your portfolio, but this would be what's considered a balanced portfolio. I have global equities, I have fixed income, both credit as well as government bonds, high yield, some emerging market. Then I also have alternatives, including real estate, including private equity, including commodities, which are different than just gold. Gold deserves its own role within a commodity sleeve. And then, of course, gold. And I looked at four different portfolios, Glenn, hypothetically. Portfolio A, B, C, and D. Portfolio A has 0% gold. Portfolio B has 2%, Portfolio C 5%, and Portfolio D 10%. This is over the last 20 years since GLD, our flagship gold ETF, was launched in 2004. So we looked at that time period. And what's interesting is when we add gold, that 2%, 5%, or 10%, pulling from equities and bonds, here's what we get. This is kind of, not to get too technical, a little bit of an efficient frontier where we have portfolio A right here. These are not returns. The returns are here. So as you go to the right, there are more returns. As you look at the left, that's volatility. So portfolio A had 0% gold, but it was a balanced portfolio, has higher volatility and less returns than the portfolio with 10% gold, which has higher returns and lower volatility. So what we tend to find in this quantitative and empirical exercise is that having 0% gold, having no allocation is probably a mistake. Not that past performance, again, I'll say again, Glenn, is indicative of future returns, but gold has historically shown a resilience in portfolio. It does three things. One, it lowers volatility for your portfolio, so it can enhance risk-adjusted returns. Two, it essentially lowers your maximum drawdown. So when markets are selling off sharply, gold can provide that buffer, right? That's a second portfolio advantage. And the third thing that it does is it provides this diversification benefit that over the long run can provide higher annualized return.
So
So,
I have another question for you with that.
sure.
So who's good? Who's I guess the best way of asking this is who is it good for? So we have a multitude of people who are here today, and we've had people who are in their 30s who are accumulating wealth and
Mhm.
they're maybe more aggressive in their investing. Then we have people who are retired as well,
Yeah,
who are listening, where volatility is more of a concern
absolutely.
for their retirement income.
So, look, Glenn, I think the best answer is it depends. So, I do think each client is a bespoke solution, and I'm sure you provide bespoke solutions. I don't, we first met today, but I can already tell that you're probably looking at each individual client and figuring out their needs, their goals, what their risk tolerance is, and how they can implement appropriate investment strategy. I would say the same. So, look, I'm not trying to dodge the question. What I would say is 0% is too little, but 100% is too much,
Zero
right?
zero
So
percent in any portfolio.
I would say zero.
I just want
I
this.
would say most
Oh,
portfolios,
okay.
unless it's a very sector specific or very retirement focused portfolio, I would say
Okay.
most portfolios, particularly after tax, but even
Hmm.
some within an IRA. I know several people who own it in an IRA. It can work for a couple of reasons. One is that we're not asking, and I don't think anyone would recommend, myself included, that gold should be a majority or even a large portion of your portfolio. That's why it works. Yet, what we find in our strategic case of gold white paper and empirical work is that 0% is too little, or not right, but 1 to 2% is not meaningful enough to get the portfolio results. It's kind of too small. It's just window dressing. So really, starting at 3 to 5% for a more small allocation can really work well. And for those who believe that we're in this new regime, this new structural cycle, which I'll talk about, hey, I'm really concerned about debt issuance. I'm concerned about bond issuance and how much the government is borrowing. I'm worried about the dollar over the long run. They might want a 7, 8, 10, even as high as 12 to 15% allocation. And just don't take my word for it, Aakash Doshi. Several of our partners, including Ray Dalio, the founder of Bridgewater, is a big believer in gold, and he actually recommends 10 to 15% allocation. So again, I'm not providing any specific recommendation. In fact, I'm not even able to see the people on the webinar other than Glen right now. What I am saying, though, is that it is a consideration. And for most portfolios, not the perfect answer, we think a little bit of gold works for, for these reasons. And again, this is a pretty balanced, diversified portfolio that I'm showing here: equities, fixed income, alternatives. And we can see that gold, at least in this historical context, tends to enhance returns, lower volatility, and reduce maximum drawdowns. Great questions, though, Glenn. Now, how about now? Right? So, what do I think about gold prices? So, obviously, these will adjust. These are from the beginning of April, although I haven't adjusted this price outlook since February, even with the war. I think we're in a new higher gold price regime post-pandemic. I'm going to talk about those structural factors that are supporting gold, not worried about the day-to-day trading, but more what's the medium-term outlook. Because Glenn, gold was the number one performing major dollar-denominated macro asset class in 2024, just beating out the S&P 500. It was the number one major dollar-denominated macro asset class in 2025, up 65% last year.
Yep.
Now, I'm not including small things like rare earths or uranium and stuff like that. I'm talking about real global fungible assets with hundreds of billions, if not trillions, invested, right? So I think we have to be fair. Of course, there could be some random ETF or a random rare earth that outperformed, or just some random small cap stock. I'm talking broadly against indexes across bonds, etc. So, I think you have to take a signal of why the market has been rallying in this post-pandemic regime. And I'm going to talk about some of those structural factors. But why I think $4,000 an ounce is a support level for gold, why I think 5,500 is likely to be achieved again by year end or early 2027, and why I still think 6,000 is not out of the realm of possibility over the next 12 months. Now, in the very short term, people might be wondering, hey, Akash, this war in Iran, oil prices spiking, why isn't gold rallying? I think in this unique environment, you have a situation where this oil supply shock has changed around Fed pricing. It's changed around the dollar trend. It's done a lot of macro adjustments, and a lot of people have been using gold as a liquidity sleeve. They've been using it to raise cash. That's part of its role in a portfolio. It's a very liquid asset, and you can use it to raise cash during periods of stress. I think that's been a bit of an issue. Now, if you think the conflict in Iran is going to end in the second half in advance of the midterm elections, which the White House might want it to end by the midterms, and oil prices, I don't think they're going back to $60 or even $70, but if they stabilize even around the mid 80s, I think gold will immediately and very quickly go to $5,000 an ounce through the Fed and dollar channel. However, if we're in an oil price for longer, higher for longer regime, 120, 130, 140 oil, and we don't rule that out, I think that could be a buy the dip opportunity for gold. I think 4,000 support will relatively hold, but I think you could get to the low 4,000s, and that could be an attractive point to re-engage with gold in your portfolio. versus what we saw earlier this year when levels were well above $5,000 an ounce. But let me
So
talk
another
about some.
question, another quick question.
Yes.
So what's the correlation between what the Fed may do and all and even the war in Iran and the price of gold? How are you looking at where you feel pricing will go based on these things that are happening in the world right now?
So uh, the importance of the Fed and the dollar are very important in the short run because the gold is priced globally and traded and denominated in dollar terms. So if the dollar is weaker, gold tends to rise. If the dollar is strengthening, gold can struggle. That's not always the case because gold is global. So Chinese investors are buying gold for different reasons than US investors.
Mhm.
And we can talk about that. But there is a strong inverse relationship, and I'll show you a chart with that. The
Okay.
second point, though, is Fed pricing matters, but it's the extent that Fed pricing changes. So, right before the war started, Glenn, the market was expecting 2 to 3 Fed cuts in 2026. Today, the market is expecting 0 cuts and even the risk of a hike. That's a pretty rapid change in the Fed outlook in just a couple of months, largely driven by this oil price shock and the return of inflation. So, gold in the short term could be tactically used as a profit taking center or as a liquidity sleeve, like I said, or get some headwinds from higher yields, higher rates. But in my view, over the medium term, the war can actually exacerbate some of the tailwinds for gold. Military spending, emerging market subsidies for energy that adds to debt and deficits globally. Also, geopolitical fragmentation that will increase because of this war over the long term, not decrease. So, let me talk about some of those structural factors and we can bring that in. But what I want to do is present a strategic, structural case for gold here over the next 10, 12 minutes, as opposed to just a tactical trade in and out. So one is global debt loads, right? So I think this is a very interesting chart that I've created that looks at global debt. That's the green line. And this is household debt, corporate debt, government debt, and financial debt, not just in the US, but the US, Europe, China, Australia, Latin America, Asia, and so forth. And what's interesting is that you've seen that global debt rise steadily over the last quarter century. You could say again, so what, Akash? Population has grown over the last quarter century. Debt should be rising as well with population growth. I think what's interesting is I decomposed that to this blue line, which shows the government share of that global debt. And you can kind of see two V shapes. One was after the global financial crisis, and the second was after the COVID shock in 2020. And what's interesting is the government share of debt never reverted or never retreated back to below the levels below before those shocks. So the GFC was a big one, COVID was a big one. So what does that mean? I think when you hear or read about debasement or alternative fiat or lost purchasing power, this visualizes it. Government debt is now over $100 trillion globally. Government debt. Global debt is now more than 3 times global GDP. Is that a tipping point? How will this debt ever be paid off? Are you going to have a restructuring event in advanced economies in the US and Europe, the way you have in emerging market economies throughout history, whether we look at LATAM, Sub Saharan Africa, Southeast Asia, and so forth? So I think when you think about a neutral store of value that provides you that real return that beats cash plus inflation over the long run, I think that's a very interesting, this is a very interesting chart that really underpins gold demand in the post-pandemic regime particularly. So that's structural factor number one. Rising global debt, rising government debt, and hopefully this is a very interesting way to visualize it. I think the second is from a portfolio allocation standpoint. Okay. So I hope these charts aren't too busy for those watching, but let me explain to them. The blue chart or blue line is US equities bonds, and that's their correlation over a rolling 3-year return quarterly return basis. The green line is US dollar gold relationship. So I just want to highlight a couple of things here. One is that we went through this period from the late 1990s all the way through 2021 where stocks and bonds had this inverse relationship. 60-40, 70-30 worked very well because bonds provided you that hedge and were inversely correlated on balance with equities. Then in 2022, with the Fed starting to hike, the Russia-Ukraine war, inflation, post-pandemic, you saw stock bond correlations rise to multi-decade highs. And they stayed there in 2022, 23, 24. Even in 2025, 26, as stock bond correlations have come down and normalized a little bit, they still remain pretty elevated. So my thesis is I don't know where stock bond correlations will go with certainty, but I think there's a good risk that they're in this new regime where they're at least positive. And if they are positive, I think that leaves room for alternatives, diversification hedges, duration hedges like gold to fit into that portfolio. Separately, the US dollar and gold relationship is relatively anchored. It's negative. So if you feel the dollar over time will lose purchasing power or devalue, gold is a great hedge in that environment. So this, I think, couples together well from an asset allocation framework standpoint. On the right side, I'm looking at another factor that's emerged post-pandemic, but really under Trump 2.0, and not trying to be political here, but that's geopolitical fragmentation and economic policy uncertainty. And there's ways you can measure that, because when you talk about things being uncertain, what does that really mean? So there's machine language and natural learning models that look at things like Twitter feeds and headlines and news reports, et cetera, and they aggregate it all together to come up with an uncertainty index. Is uncertainty high or low? What we can see under Trump 2.0 is that the economic and political and geopolitical uncertainty is not only extremely high versus Biden and Obama, but it's more than double Trump 1.0, which is this period right here. So in that sense, when you have a lot of geopolitical fragmentation, economic uncertainty, what's going to happen with U.S. trade policy? What's going to happen with U.S. foreign policy in NATO? What's going to happen with the policy in Iran? What's going to happen with domestic policy and so forth? When you have a lot of these various modal probability and distributions that can happen, gold serves as kind of your left tail reserve hedge. And I think Trump 2.0 has actually been very positive for gold. And you can see that in the returns since he's taken office again. Another question or another structural factor that I like here, Glenn, is that gold is not yet a crowded trade, in my view. Gold is still underallocated or underowned by wealth clients, institutional clients globally. So this is, again, an interesting global view, not just a US view or not just a wealth view, but this is global. So what I did here is I looked at global gold fund holdings as a percentage of worldwide ETF and mutual fund assets. And what you could see is that despite gold's 65% return in 2025 and growth in mutual fund and ETF assets globally to over 60 trillion, gold still represents less than 1% of that, just under 1%. That's well below that 3, 5, 7, even 10% strategic allocation we think is right for most portfolios, in which many asset allocators and portfolio managers are now investigating, at least dipping their toes in. So we think there's room for this financial gold ownership to grow because it's still not over allocated by what we think is the right strategic holding. So I think that's critical. Gold flows, they have been very volatile this year. We had record inflows in January and February seasonally. Then we had record outflows in March at the start of the war as people used gold as a liquidity and cash raising instrument. Then we started to see inflows in April, and now the flows have stabilized in 2Q, right? You're not seeing strong inflows or outflows. I think a lot of the market is waiting for what happens with Iran, what happens with Fed policy, and so forth. But what's critical and what's been important is the central banks have kept buying, and that includes in 1Q of this year, including in March when the war in Iran began. And this central bank demand story for gold is very critical. I talked about it in the very first slide, where central bank demand for gold, which is now 25% of primary mine supply, that is non-cyclical demand. Why is that so important? These central banks that were selling for 40 years after the Nixon shock from the 1970s, 80s, 90s, 2000s, they were selling every year, providing gold supply to the market, not buying gold. That changed after the global financial crisis, and they have now bought 16 straight years. And dare I say, they'll be buying for another 5, 10 years further, minimum, to meet their strategic allocation and reserve goals. And if I'm wrong 10 years from now, many of you might not remember this webinar, so that's okay. But I think I've been right on this call because I've been writing about this phenomenon for about a decade. And I've suggested that they continue to buy for the decades to come. And I've, been correct so far. And
So
I
so
think this is important.
as long as the central bank of the Fed's buying gold, we should certainly look at it and have and expect some appreciation.
Yeah, I wouldn't say that's the only reason, Glenn, but yes, I would say empirically it does two things. One, it damps downside volatility, and two, it lifts the price floor. The reason for that is this is mostly emerging market central banks. The reason they're buying gold is not the reason your clients are buying gold necessarily. They're buying gold for geoeconomic, geostrategic reasons. The reason China buys gold is not to have outsized returns in year one. The People's Bank of China, they want to challenge the US in global hegemony. They want to diversify away from dollars and the treasury. They want to onshore some of their reserves as a hard asset. So there are a lot of different factors that are driving the central bank demand impulse. I think the key is so long as it's this positive, I do think it supports the gold price narrative and gold price floor. And especially if investment demand comes on top of this and physical demand comes on top of this from other sectors, that leads to a tightening of availability of gold and that leads to higher prices.
Okay, makes sense. Thank you. And this
Of
FYI,
course.
we probably have 5 more minutes for your
Yep,
presentation. We're already starting to get a lot of questions, so I
absolutely. I'm
want
going
to
to
make
wrap
sure
it
we
up. How
save some
about
time for that.
I wrap it up in 3 minutes? But this is to your point. I just want to show you guys a chart because this is a very interesting chart again, and I hope this is helpful for you, Glenn, and all the audience. This is the US dollar share of reserves, this blue line. Look at what it's done over the last 15 years. Trending down. Here's the gold spot price share of FX holdings. It's rising. Now, some of this is due to prices rising of gold. A lot of it is due to inflows of the central banks, specifically post-pandemic. So I think this is critical because I'm just going to give you one fact and then we'll move on, is that gold overtook the euro in 2024, early 2025, as the number 2 reserve asset in the world by value. So it's only the dollar. Then after that is gold as the top reserve asset from the official sector globally. I think this is fascinating. This is not something anyone would have thought possible 15, 20 years ago. So clearly, central banks are doing this for a reason and something important. Lastly, I'm going to just leave it with this last slide. How do we access gold, particularly through State Street Investment Management? Well, we have our two tickers here, GLD and GLDM. GLD is the largest and most liquid gold, precious metals, or commodities fund on the planet, ETF on the planet, as far as in that sector. Then GLDM is our mini shares, still very liquid. If you're looking to rebalance frequently, liquidity is really important. Options, trading options on gold is important. GLD is a great tool. It's embedded in the institutional gold ecosystem. If you're looking for a set it and forget it holding, just I want a strategic core allocation to gold. I don't want to trade in and out, not looking to rebalance it frequently. The GLDM is a great solution as well. These two tickers are physically backed gold ETFs. They're 1933 Act products. There's no derivatives behind them. There's no lending of the gold behind them. There's no overlay. Very simple structure. These GLD shares are backed by 1/10. Each share is 1/10 of an ounce of gold, less the expense ratio. GLDM, each share is 1/50th of an ounce of gold, less the expense ratio. Combined, these two funds have assets under management of close to 200 billion. So they are very large, they are liquid, and it is the preferred way for many investors to get access to gold, spot gold, through the ETF ecosystem. So with that, Glenn,
Okay,
I conclude my remarks before the
thank
5-minute
you.
buzzer, and I'm ready to
Great.
continue the conversation.
Great. So first question is, what do you think about, there are a lot of benefits of buying gold in the ETF, but you hear and see it on TV about buying gold directly and holding gold bullion, these bars,
Yeah.
or coins. You have any thoughts or insight about that, especially if you're looking at for the same reasons of investing, but
Yeah. No,
also using it in
absolutely.
the future?
Absolutely. That is a great question. And let me answer that directly. Gold ETFs, particularly GLD and GLDM, are very efficient ways to get physical gold exposure. What do I mean by that? When you buy physical gold in any sizable quantity, right? I'm not talking about my wedding ring, right? If you have your wedding band, you're going to wear it on yourself. That's a little bit amount of gold, of course.
Mhm.
But if you're thinking about any allocation to gold that's a little bit more than underneath grandma's mattress, how are you going to do that? Well, one is you're going to have to pay for vaulting. That's a cost of buying physical gold. You have to pay for insurance. And then to transact in that gold, Glenn, you have to pay what's known as a transaction cost. In the market, it's known as a bid-ask spread. So when you're buying physical gold, even if you're an ultra high net worth client at one of the major Swiss, European, or American banks, names you would have heard of, household branches where many of your clients might bank. If you're buying physical gold, you might be paying 2, 3, 4, even 5% markup because there is a physical premium that needs to be taken into account in that market. Whereas GLD, GLDM embedded in the London Bullion Markets Association spot market, you can transact $100 million of GLD and potentially pay 1 basis point transaction cost. One
Mm,
basis point, right? So I think of gold and gold ETFs as a very efficient way. Some clients who are really big believers, what I say is try to do both. You can have some physical gold if you want to keep it in your safety deposit box or under grandma's mattress or in your home vault. Keep some. That's fine. But the other reason, and this sounds pedantic, but it's actually a very good reason, is GLD and GLDM in your portfolio. You can see it with your other assets. It's not a hidden asset. It's right there to see how it's performing, what it's doing, how it can be rebalanced very easily, right? You can have fractional ownership, etc. You can do smaller units, larger units. You can overweight, underweight. It's very tough to do that in the physical market,
mm,
right? I mean, you cutting up the gold in smaller
mm.
bar, you have to, pay a physical markup, etc. So I think when you need that liquidity, when you need to rebalance, when you want to see it in your portfolio, many of your clients, they might see their home equity as their biggest part of their worth, depending on what kind of client they are. you can't really see, you can't trade. That's illiquid. It's
That's
kind
right.
of in your
It's not liquid.
background, but you don't value it every day. I really like the idea of just seeing your gold holdings in your financial portfolio.
Okay. No, thank you. Thank you.
Hope
Next
that helps.
question. No, it does. Aside from the war in Iran affecting these markets, what developments or risks do you think could possibly push gold into the bear case scenario you mentioned earlier?
Yeah. Look, I think the bear case scenario, like I said, is $4,000 an ounce. I think 4,000 will hold. So right now we're at 4,500, 4,500 exactly as we speak today. So I think the risk is still asymmetric to the upside, meaning I think the next $1,000 move is higher, not lower, but the next $500 move could be lower first before you go higher. So what are those risks? I think if oil prices stay where they are and rise further, and you have this energy cost push inflation globally, then I think the Fed not only is on hold for longer, but potentially has to hike. The hand is forced. And what we see is that if the Fed is on hold, gold can do very well so long as the Fed's going to cut. You saw that last year. Fed was on hold for 9 months, gold rallied 43%. If we're in an environment though where the Fed is on hold and there's real hawkish risk and the dollar is strengthening because of that, because of US is a large oil exporter now, an energy exporter, but and the Fed is on hold, so you have these rates differentials that are favoring the dollar again, then yeah, I think gold's going to get a little bit of a headwind, and I think you're going to test 4,000. Why I think 4,000 will hold is because even in March and even at the start of this war, China has kept buying. China had inflows in March, even as the West had outflows. The PBOC, the central bank in China, has bought 18 months in a row consecutively. So I do think we have to remember that gold is a global fungible asset. And while the Fed and the US dollar matter a lot in the short run and for tactical reasons, I think some of these structural narratives are still in place, whether it's the China demand story, but more importantly, the debt and deficit story, I think in the medium term is exacerbated by this war. The CBO, the Congressional Budget Office, Glenn, in February estimated that the U.S. cost to service federal debt in 2026 will exceed 1 trillion with a T this year for the first time on record.
Yeah.
That was before the military spending and war spending. That was before treasury yields backed up and increased interest costs for new debt issuance. Second, geopolitical fragmentation. I think over the long run, just as Russia Ukraine did in 2022, this will lead to greater geopolitical fragmentation potentially. That adds to gold demand from official institutions as a neutral store of value. So I think the medium term case for gold is stronger because of the conflict in Iran. But the short term, yes, you do have to face a potentially hawkish Fed, potentially stronger dollar. That could send prices 10% lower before a 20% rally, in my view.
No, thank you for that. That makes a lot of sense. In fact, I want to go to this question, but um, you talked about gold as a global, and especially as we think about China. Um, and you've mentioned earlier about just the reserve currency. Um, there's talk about it changing. The dollar won't be the dollar anymore. It's going to be some other currency in the future, whether it's Chinese or something else. Um, do you think that's probable in the near term, 5 years or so? Um, Also, if it does, if there is more of a shift there, how does that affect the price of gold? Or how should we look at gold? Or
That's a very great
any different gold?
thought-provoking question. So let me
Okay.
clarify. So one, I don't think the dollar is going away. I am not one of those people who think the gold standard is returning or that the dollar is going to not be used tomorrow or next year or even 5 years from now. Okay.
Okay.
Like you, Glenn, I assume I'm paid in dollars. My stock market assets are in dollars. My spending for my kids' tuition is in dollar terms, right? I don't think that's going away. what I think is important to remember is just what the trend is and what the size movement is. And what I mean by that is, gold is a large global market, but it's still relatively small compared to equities and bonds. So even just a little bit of allocation shifting away from, for example, government bonds into gold can have an outsized impact on price. Second, the central banks are in the midst of reserve diversification. I don't think they're going to get rid of all of their dollars in dollar recycling, but they're adding incremental gold to their holdings to just diversify their own reserves and their own reserve management. So I think that combined with the size of the gold market, I think that's just a trend that really elevates the gold price. I don't think the dollar is going away. I don't believe that paradigm shift is there at all. I think there'd be huge socioeconomic issues globally if we tried to move away from some sort of fiat system right away. I don't think governments would want that right away. However, given these debt and deficits, given this inflation impulse, given purchasing power issues, I think people are using alternative fiat in their portfolios as just a way to hedge some of those issues.
Okay, no, thank you. Final question that we have. What about gold production? So, we've noticed or heard that gold has been discovered here or there over the last few years. And I'm not sure if gold production is more or less than it's normally been. But how should we look at that? If we're looking to invest in gold, is production something that we should monitor as well? Or is it something that you're looking at more importantly?
Well, yeah, look, that's something I look at. I think at the end client level, it's tough, right? You probably, if you invest in energy, you're probably not looking at every single energy producer and how much each country is producing. That's typically the work of a financial analyst. But look, production matters, supply matters. What I would say is three things. One is supply uh, grows slowly for gold. New mine production is between 1 to 2% per year, right? There is no to use a commodities example, I don't, if some people don't understand this, I apologize, but there's no US shale or glut of gold the way there is for energy and oil and gas, right? So US oil and gas discoveries have been huge over the past decade, and that's helped moderate energy prices, this current war shock notwithstanding. There is no such thing for gold at the moment, right? Gold is
Mm,
mined in 6 continents in the world. Antarctica, if they ever find reserves, I'm sure they'll do it at these prices. But it's mined in 6 continents. It's very fragmented, a lot of political strife to extract the gold. It's very expensive to do so. So mine production grows. I think it's still going to continue to grow over the next half decade. But at some point, it might plateau and things will get a little bit tight. And that's why I think the demand side really matters here. I think that's why there's been some stockpiling from sovereign nations as well. To that end, of course, if there was a glut of gold suddenly available, let's say central banks just started selling in mass, that would be very bearish for gold, in my view. But every sign over the last 16 years shows the opposite.
exactly. Exactly. Well, this has been wonderful. I know I've learned a lot. I'm sure our attendees learned. Thank you, Akash, for doing this. And this is, we hear a lot about gold. And of course, buy, and you hear about the coins or various funds. But now we understand why it should be a part of many portfolios. So thank you. And thank you, everybody, for attending. And we'll see you guys next month. Bye.
Thank you.
Thank you.